Hi everyone, welcome to World Affairs in Context. Please take a second now to follow the podcast just in case on alternative media channels. You will find them linked in the description below. In this quick update, I would like to walk you through the latest economic data points related to US population, US consumers, that I believe is very important to be aware of. You're not going to see this anywhere else in such a snapshot, easy to use, bite-sized version. Why do I think this is important? Well, this quick snapshot that I would like to share with you right now will give you a general idea where the US population stands, and it will either confirm your worst fears or, well, I think there's no second alternative in this particular case. Not to be negative, but I think that the data that you will see right now will be quite gloomy. The Federal Reserve is meeting again on November the 6th and November the 7th. It might deliver a rate cut. Right now, the probability of a 25 basis point rate cut at the November meeting is quite high. And it will be interesting to see what Jerome Powell tells us about the labor market and whether there will be any job revisions and the economy overall. Let me share with you several interesting numbers that might surprise you. This particular chart I shared in my weekly recap post on Substack over the weekend. A record $628 billion in US credit card debt is now unpaid or rolled over every single month. Credit card delinquencies, by the way, are now at a 12-year high. Over the last 3 years, revolving balances have jumped by $204 billion, which represents an increase of 52%. 52%. As U.S. consumer savings are depleted, financing the necessities, such as groceries, with credit card remains the only option for many people. And as credit card rates are now at an average of, it sounds scary, the average credit card rate right now is 24%. The higher your balance is, the least likely you are to pay it off. If we look at the age breakdown, we will see a very concerning trend. The majority of those in the United States with the highest credit card balances are individuals 55 years old through 74 years old, whose average credit card balance hovers just under $8,000. Now, this is very sad because these are the people who likely live on fixed income and they don't have additional ways to make up that gap between the rising prices and what they can afford on a monthly basis. And this is true for all ages, of course, but the older you get, the less likely you are to be in a position to have one or more jobs to supplement your income. According to a recent survey, the majority of US consumers now live paycheck to paycheck. By the way, if you're not yet signed up for my weekly recap newsletter, these are the type of quick updates that I post to sum up key events at the end of the week. You can become a subscriber at worldaffairincontext.com. A survey conducted by Bank of America shows that almost half of U.S. consumers, if you look at the dark blue portion of the chart, they now live paycheck to paycheck. This is not surprising because the basic necessities continue to rise in price, such as groceries. Food prices reached a new all-time high in September and are up 23% since 2021. Has your salary or your hourly rate gone up that much to make up for that price increase? The answer is probably no. The third point that I would like to make today is that housing affordability continues to deteriorate. Even though the Federal Reserve cut rates by 50 basis points, mortgage rates are actually skyrocketing. Home buyers can now expect an average interest rate of 6.86%, which is an increase from 6.64% just last week. These rates are as of early morning on October the 28th, and they have already gone up since then. At the end of the third quarter, the median U.S. home sold for $420,000. The housing market is effectively frozen with high rates and high prices. This means that after a buyer makes a 20% down payment, let's say, their mortgage payment would be nearly $2,500 per month. Of course, you have to add property taxes to that amount, and also you'll have to add your insurance costs. So this means that you need to be in a position to comfortably pay a $3,000 per month mortgage payment if you would like the luxury of owning a home in the United States right now. With an average monthly US income of $4,935 according to Fidelity, home buyers are now spending over 50% of their post-tax income every single month on home payments. The fourth important fact that I would like to share with you today is extremely concerning, and I think that this is something that will cause extreme headache to many people who purchase new or a used vehicle in the last 3 years. According to Edmunds, the United States consumers are literally drowning in record high upside down car loans. 33% of American car owners trading in their vehicle owe more on the loan than their car is even worth. This is the worst position to be in, especially with respect to a quickly depreciating asset such as a car. What's worse is that we are not talking about a couple of $100s. No, the majority of these people are upside down on their car loans, an average of $6,500. This is absolutely insane. So they have to pay the bank out of their pocket to make up the difference if they wish to sell their vehicles. Used vehicle prices in the United States have dropped by nearly 25% over the last 3 years. So this is why the difference between the vehicle value and the loan value has gotten so high. Lastly, let's quickly chat about delinquency rates for credit cards and auto loans, since those two are the main types of consumer credit. As you can see, both indicators increased in a virtually straight line in 2024. The data that you're seeing right now is as of the second quarter of this year, because the third quarter is not published yet, but it certainly gives you enough information to set expectations of what we might see through the end of this year. As more Americans are falling behind on their debt payments, they also face increased stress as the result of a rise in the cost of living, with food prices being up more than 20% in the span of 3 years. Regardless of the fact whether or not the Federal Reserve cuts rates in early November, we are unlikely to see any major improvements because a rate cut of a 25 basis points will be barely noticeable in the short term when we have so many other factors at play contributing to the overall degradation of consumer purchasing power and the general ability to maintain the same standard of living as we are used to across the board. Let me know if this quick update was interesting and useful in the comments below. I would love to hear from you. Thanks for watching. Remember to like, subscribe, and share. It goes a long way. And for more content, check out my alternative social media channels. Take a look at my Substack at worldaffairsandcontext.com, and I will see you back here tomorrow. Enjoy the rest of your day. Bye for now.